Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. And I want to put in a quick plug for our ETF.com nominations for Leaders List, spotlighting top financial advisors and advisory firms. That's a brand new thing we got going on here. Take a few minutes and check it out, and maybe end up on the list.
Absolutely. Check that out on ETF.com. In this week's episode, we're talking with Tim Cramer, CEO of CNIC Funds.
Hey, Tim, how you doing? Thanks for being here.
Appreciate you guys having me. Thank you.
All right. Let's kick this off. Tell us a little bit about yourself and about your firm.
Sure. So my name is Tim Cramer, and the firm is called CNIC. And what we've done is we've created the first ever ETF that is based on electricity futures. So our whole premise was this. If you take a look at the commodity space, you've got somewhere between $500 billion to $800 billion that's tied to commodity indexes like the Bloomberg Commodity Index, which is the BCOM, or the Goldman Sachs Commodity Index called the GSCI. But it just didn't make any sense because electricity is the most consumed commodity in the US on a retail notional basis, but it wasn't in any commodity index. It wasn't in any ETF, any mutual fund, nothing. So what we did is we partnered with ICE, the Intercontinental Exchange, and we created the first ever electricity futures index. And we've got a 5-year exclusive on the data and the index itself. We launched that index back in January of 23. And then in May of 23, we launched our ETF. The ticker is AMPD, AMPD.
That's interesting. So, Tim, you mentioned that you have all these commodity indices, the Bloomberg Index, you have the Goldman Sachs Index, and they didn't include electricity futures. Why do you think that is?
So those commodity indexes were first made like back in the 70s, and then they didn't become commercial until probably about 1998, I think, when the first mutual fund came that was tied to one of those indexes. So it took a while for people to kind of get, the understanding of what you could use those things for. And the original intention with those original funds were that they were mapped to CPI. So that's how the commodities were chosen. So the commodity investments were there for portfolio diversification and for inflation protection. And at that time, electricity, was just starting to get traded around, the year 2000. So it wasn't included at that point because it just, wasn't around enough. And then once electricity from like 2000, 2010, it started to trade on ICE, the Intercontinental Exchange, and it became a little bit more, mainstream. Then people started to pay attention to it. But then now you've kind of got double tailwinds, we'll say. The first is every time you pick up the paper, you're reading about electricity demand, AI demand, things like that. And then the second is just kind of the renewable tailwinds, because everybody wants to see the grid go from its current configuration to being 100% renewable by sometime between 2035 and 2050. So that's kind of, you've got a more seasoned, more developed market right now, and you're getting much more press with it. So people are starting to pay attention.
That makes a lot of sense. And I want to talk about more of those tailwinds in a bit, Tim. But before we go there, I know a lot of viewers watching right now, they're familiar with ETFs tied to commodities like oil and natural gas, but they're also aware that those type of commodity ETFs have performed poorly long-term because of contango and the structure of the futures curve. Is there a similar type of situation for electricity futures? Is this more of a trading vehicle, or could it be held for a longer period of time?
That's a great question. There's a lot to unpack there. So specifically, to just kind of refresh some of the fundamentals here, if you are a market that's in contango, it means that the farther out you go on the curve, the longer dated futures that you look at, they're kind of higher in price. And that goes back to the whole textbook thing with, John Maynard Keynes and Holbrook Workings, guys like that, where the future price equals the spot price times E to the RT and that math. But it's basically like a cost to carry. The issue with the electricity market is it's almost always in backwardation and not contango. But when we talk about the backwardation, we're not really talking like, month one versus month two. Electricity is not storable. So that, cash and carry, that arbitrage equation doesn't really hold. And so instead, what we did when we designed this electricity index in the ETF, rather than taking just the prompt contract like the BCOM or the GSCI does, we take a 12-month strip. And so what happens is, like right now, you're in July, so the prompt contract for us is August, and we're rolling out of the August 24 contract into the August 25 contract, because the mindset is, because it's not storable, August should be like August. And typically, historically, I think it's like about 80% of the time, these markets, when you look at a month-to-month basis, when you're doing it over the 12-month time frame, so you're comparing like August to August and like December to December, when you're comparing that way, about 80% of the time, those markets are actually in backwardation, which means the more current contracts are higher priced than the other ones. So what happens is, with our product, you typically, not always, because it doesn't always persist, but you typically will get positive roll yield, which means you're able to catch that backwardation. So the index itself goes all the way back to like 2014. That's when ICE used the data to start the computation of that. And so the roll yield, which is that backwardation piece, you've averaged over the past, we'll say 7 years, that at an annualized basis, that's giving you like an incremental 3%. Now when you're at extremely low prices, the markets tend to flip into contango like you see with the other commodities. But for the bulk of the time, under normal circumstances, the electricity has historically been in backwardation.
Tim, you said this goes back to the index goes back to 2014. I'm assuming that you used some back tested data then when you launched this or to initially talk about it or analyze the strategy.
Oh yeah, right. So there's a ticker on Bloomberg for these indexes, and the ticker data goes all the way back also to January 1 of 2014. And so when we created the index and we did all the back testing just to make sure the index itself was a viable product, we did everything based upon that entire history of data.
Now, as an ETF that is based on futures contracts, and Smeed already asked you about that, the buy and hold versus a trading vehicle. Are you happy with what you've seen so far with this fund? I mean, it's a fund that it seems like it would have a lot of nuance there. It's not the kind of, well, first of all, it's the only one like it. So financial advisors aren't going to say, well, which one of these should I pick?
Right.
Is it even getting on anyone's radar screen? I mean, it's been around a little over a year. Its performance is not great, but I don't know, maybe that's what you kind of would expect from this, but the assets are also very low. What's your kind of 1 year review here?
Sure. So for the 1 year review, I would say this. First of all, we're kind of a bit constrained because a lot of the big pensions and endowments are just the RIAs. Can't really put money into something unless it's got at least a 1 year track record. So we just cleared that hurdle, last month. The second hurdle is there has to be a certain amount of AUM involved in this before some of the institutions can put money into it. So we're working on clearing that hurdle. Because this is something new. It's the first ever. And so there's an education process here. And so we are working on partnering with a few different groups that can help us with the distribution. Basically have a sales force and have certain relations so they can help us educate the investing public about what this is and what it's supposed to do. So if you look at just the stock price, just AMPD, so yeah, it's sitting there and we're down maybe 10% since inception. But also remember that this thing pays the equivalent of a dividend in terms of a distribution, because when you buy these electricity futures, if you buy $100 worth of futures, you put $15 in with your broker, and the other $85 gets the risk-free rate, 3-month SOFR. And so you get a distribution that is almost equal to the risk-free rate. So you get paid to hold this so that the fundamentals are going to do, what you think they're going to do.
All right, let's talk about the fundamentals of the power market, the market that you're participating in here. If I'm an investor, is the fact that where there seems to be increasing demand for electricity the reason I should invest in this, or because there's more of a push toward electric everything, or is it because of the rising prices of electricity? Why, getting beyond the kind of the minutia of how this is actually structured and operates, why would I invest in this?
Sure. So typically there's two reasons that people would buy an ETF. The first is strategic, which is why should I buy and hold it forever? And the second is tactical, which is why should I buy it now? So if we look at the strategic reasons on why should you buy this and hold it forever, we break it down into three. The first reason would be the model portfolio. So if you take a look, I always pick on my parents, Mom and Pa Kramer, and the investment advisors tell them, okay, 60-40, 60 stocks, 40 debt. And now that's kind of falling out of favor. So you've got the investment advisors pointing to 60 equities, 35 debt, and 5 commodities. And over a long enough time period, on an absolute basis and a risk adjusted basis, it does beat the 60-40. If you look at a 60-35-3-2, 3 commodities, 2 electricity, it beats everything. So from, not just looking at a small snapshot, but looking at this over time and what it does to the portfolio, we think it makes sense to be in a model portfolio. So that's reason one for strategic. The second reason would be if you take a look at portfolio diversification, electricity is not correlated to anything. And so, not stocks, not bonds. So it gives you that diversification that people look for. And then the third would be inflation. So every month after month, when the CPI comes out, 2.5% of that directly is electricity. Now, that's just the direct piece. Now, the indirect thing, as you talked about with like everything becoming electric, one good example of that would be like retail grocery stores. The average is about 15% of their OPEX is electricity, and they have like a 1 to 2% profit margin. So you can see what an increase in electricity prices would do directly to CPI, but there's an indirect component that's also going to be pretty big. So that's kind of the strategic. The tactical reasons, like why should you buy it now? We break that down into just kind of the supply demand fundamentals. And so we think that number one, the demand in the US is grossly understated. So when it comes to AI and data centers and Bitcoin and just overall industrial demand, we think that's understated right now. We think supply is greatly overstated. As the US is pushing towards like an all renewable grid, the problems that you have, it just takes too long to build that out. And you're just retiring thermal generation at a faster rate than you're replacing it with the renewables. And then there's a reliability issue, which is as you take baseload generation or dispatchable generation, which is thermal generation where you can vary the output, and you put in these, wind and solar, this renewable where you can't vary the output, then you've got just, absolute reliability issues. And you start to see that in some of the markets now, where if you've got enough wind and solar, prices are fine. And if they don't show up, prices will go up to be several $1,000s. So that's kind of the tactical reason, and that would be the strategic reasons why we think this makes sense to have this in a portfolio. And mind you, we're not saying that you should put 30% of your portfolio in this. We're saying that this has a certain allocation, more akin to a piece of what your overall commodity strategy might be, or just a piece that kind of mirrors what inflation might be.
If you're a financial advisor and you want to hear about the latest insights and strategies in portfolio management, make sure to also subscribe to Advisor Upside, available wherever you get your podcasts. Tim, I just pulled up a chart on Bloomberg of the index underlying the ETF, and it looks like, it's kind of flattish from 2014 through 2020, and then all of a sudden it just rocketed higher, quadrupling in value. Is this the type of movement you expect for this ETF going forward? And can you tell us, what caused that big whoosh higher in 2021 and 2022?
Sure. So the big move up higher you had is when you came out of the post-COVID period. And so there was just huge pent-up industrial demand, and that contributed a large piece to that. And then the second thing was this does have an element of weather in it. And so that's where you got the big move up, is people were anticipating a very cold winter. So when you combine those two factors, that's what you get. Now, the down move, which you're not talking about in the chart, is we've had back-to-back El Niños. So the winter of December 23, January and February of 24, it was the warmest winter we've had since like 1893, I believe, or whenever the data set starts. And before that, the winter before that, that was like the warmest in the past 50 years. And so the odds of like a back-to-back El Nino occurring are like 9%. And, we basically launched into that period. And so this thing, it only was down we'll say 10% ish under the worst possible scenario. So we feel pretty good about this thing not breaking and doing what it's supposed to do because it's already been stressed real world in the marketplace with what you could design as just, the nightmare scenario for a launch.
So Tim, you touched on, AI, and we've been hearing a lot about how the boom in AI is going to cause electricity demand to skyrocket. Can you tell us what that could mean for this ETF? How much, could electricity prices go up? And, how much would that impact the returns for this ETF?
Sure. So the AI boom, and this has been kind of covered pretty well now in the press. It's kind of a pretty well accepted fact, and it's still in the paper almost like every day. So there, you're talking about, I think some of the stats people throw out is like a Google search takes 0.3 watt hours of electricity, an email takes 1 watt hour, a current AI search takes 4 watt hours, but by 2030, it's supposed to take 15 watt hours because bigger chips, they're not air cooled, they're liquid cooled, bigger databases to sort through, et cetera. So just a huge pent up AI demand that we're going to be seeing. To kind of put this in perspective, in 22, I believe it was, about 2.5% of all electricity consumed in the US was from AI. And at that time, the forecast was by 2030, 7% would be AI. But what happened is last year for 23, we went from 2.5% to 5%. So people were like, wow, okay, we gotta up this. So the forecasts now for 2030 are anywhere between 10% to 30% of the overall US electricity consumption is going to be AI. And they're kind of price agnostic on this. So between what you're looking at for EVs and the AI, the demand is big. So now how this manifests itself back into the ETF, if you take a look, just, rough percentages, if you take a look at kind of where power prices can go in terms of like the forward market, like where they've been versus where they're at now, there's absolutely good upside on this thing. There's no reason why, just referencing the index because it has a longer database, there's no reason why you can't, put up numbers in the index that are higher than what you're looking at for the all-time high.
The description of the fund, in addition to U.S. electricity futures, it says it also invests in carbon allowance futures contracts. What is that?
Right. So there are carbon allowances that trade on ICE, the Intercontinental Exchange. One of the major ones is called RGGIs, Regional Greenhouse Gas Initiatives, and those are like East Coast carbon futures. And the ones on the West Coast are called CCAs, California Carbon Allowances. And so what happens is the EPA puts out publicly available numbers on their website. And so for all of these electricity futures that we buy that are in the ETF, we take a look at that database that the EPA has, and it says, okay, this is what the carbon footprint is for all these electricity futures. And then we buy the correct amount of carbon offsets so that it is carbon neutral.
So, Tim, you've talked about the bullish thesis behind this ETF and how electricity prices could rise. How does that compare to the investment thesis for utility stocks? I've heard a lot of, positive things about those stocks and how they might capitalize on these same types of trends. What are the pros and cons of each approach?
So I would just say the parallel is it's like buying, do you want to buy a gold mining stock or do you want to buy gold futures for your commodity exposure? If you want to buy the utility stocks, I think people look at the index like XLU and it's done well. The issue is for the utility stocks, you don't know, like number one, they've got to choke down corporate overhead, which we're getting you pure exposure with the futures. They've got to cover that. Number two is you don't know if they've hedged or not. So you may think that you're getting exposure to the underlying potential rise in electricity prices, but they may have hedged that and don't really have that. So one of them is actually investing in a business and the other one is just the underlying pure electricity future. So it's a close parallel, but the purest play is to do this via the futures.
Jimmy, you got one ETF. I know this seems like kind of your life's work here.
Yeah.
You're very passionate about it, but what's next? Can you add to this lineup when you're this specific in your strategy?
So we have, we've had inbound requests for probably 7 or 8 different products that look like this. They may or may not involve electricity. And so we've got I think we got 3 more products that we're looking to launch with ICE in the next, we'll say 90 days. And we think that those can also be some interesting products that kind of fill some niches in the marketplace. So we're pretty excited about that. I just don't want to talk about it until, we get the indexes published and get moving with those. But there are some really cool things that the framework for this first ETF sets us up for.
And finally, I think there's a few references to ESG on your site. It's obviously this is an ESG strategy. Do you feel like it's advantageous to market this as ESG, or is there another avenue here? I mean, there are a little bit of a stigma around ESG. As I don't know if it's a stigma. It's become politicized. What would be your, I guess, take on that?
I'll give you the plain answer here. When we launched this, when we first started constructing the index and we launched this, if you could spell ESG, people will give you money.
Mm-hmm.
And so, which is kind of what you're alluding to there, Jeff. So we did this, set it up. And then once we launched this, the pendulum kind of swung the other way where ESG fell out of favor for various reasons. And so we've got some people that still like ESG. If you look over in Europe, it's they've been ahead of us on this. And so over in Europe, they did a lot of ESG products. People loved ESG, then they hated ESG. Now they're kind of swinging back towards liking it. So we think that the pendulum swings back towards ESG. So we think we should be okay with that. We also just say, look, this gives you exposure to electricity and the associated carbon offsets as an asset class. So you can just look at it that way. And then the third thing is, knowing that I don't know everything, we also own the index that doesn't have carbon in it. So we've got the pure electricity, no carbon, and we've got a product ready to go, but we haven't launched it yet. And we also have the one that's got the carbon offsets, and that's the one that you're looking at with AMP. So we think we've got our bases covered depending upon which way investors would like to go.
All right. Well, really good stuff. We'll keep an eye on you and CNIC funds and see where things go from here, and stay in touch with us, all right, when you have something new coming out.
Absolutely. I appreciate everything you guys are doing. ETFs are kind of a tough space, especially when you're a small shop. And so the things that you guys do to help people out like me are greatly appreciated. Thank you.
Like that episode? Make sure to subscribe to Exchange Traded Fridays so you won't miss the next one. Available wherever you get your podcast.